Good morning, everybody. Um, Dean, how you doing?
Good. Great to be here.
Yeah. So unfortunately, our captain is currently experiencing some technical difficulties. So I'm going to spare everybody the entire "Oh Captain, My Captain" poem, but know that I feel it in my heart right now, Ken. Except that you're not dead; you're just not able to connect to the show. So I think we'll get started. I'm Ned Damon, Principal Data Scientist for DAT, and I'm joined by the extremely. Oh man, I'm not good with the adjectives. I can't fill in for Ken. The pressure's too much. I'm joined by my esteemed colleague Dean Croke, Principal Analyst for DAT Solutions.
That'll
This
work.
is the DAT IQ podcast where we go, or live video cast, where we go through every week and we talk about what's affecting the freight industry. So to kind of keep the show on the rails, we're going to start off by talking about our key points for the week. Oh, wait, no, I forgot. Before we do the key points for the week, it is important to give a shout out because DAT data is live in the Snowflake marketplace. And this would normally be where I would put a big link here, but I don't think we have a link yet. But it's there. It's in the Snowflake marketplace. And it's really great. And you can have that data, and it's part of Snowflake. So if you need DAT data for any of your resources, we've got it right there in that old Snowflake marketplace. Any thoughts on that before I go right back into what I was supposed to be doing?
It's a great idea, Ned. It's an awesome idea.
All right.
It's a good way for carriers to connect.
Okay, now we're jumping back into the key points for the week. Gosh, I am not up to Ken's standards. Okay. This week, we're seeing some strong seasonality patterns emerging in dry van and reefer. Load post volumes are down while capacity is increasing, and this is causing spot rates to do a little dip. So that's exciting for everybody. Maybe not what everybody wants, but it's there. Warmer than average temperatures in January are boosting flatbed activity. So flatbed is kind of the bright spot in the marketplace. Load post volumes are up and rates are steady. And the CAS shipment index has dropped for the third month in the row to end 2020. It's now at the same level as it was in January 2018, January 2019, and H217. I'm not sure what. Can you explain H217?
Yeah, it's for the second half of 2017. H2. Sorry. That's my acronyms.
Okay. What was H217? You weren't live.
The second half.
Second half of 2017. Okay.
Yep.
Man, we're falling apart. So I think then it's time for Dean to go through the market dynamics. Dean, take it away.
Thanks, Ned. All right. Last week there was a lot of seasonality that returned to the market. We normally see typical activity like this during the year where load posts drop and capacity increases. A little bit different this year given the level that volumes drop from, both rates and load post volumes. Last week we talked about December imports being up. We looked at the peers database. TEU volumes, 20-foot equivalent container volumes, are up 22% year over year in December. So there was a lot of imports coming in from Asia. About 50% come from China. A lot of that hits the West Coast. So what we saw in our load post volumes was a lot of that import volume was hitting port markets like Houston and Seattle in week 2 after they'd cleared the docks. Very different last week, though. So volumes dropped last week as if a lot of that port volume had been cleared and moved into the different distribution markets. So what we saw in dry van last week was volumes dropped close to 30% week over week, but that's after a much higher week the prior week to start the year. So nothing unusual about the volume drop. We normally see that this time of the year. Capacity loosened and the load to truck ratio dropped from 6.67 to 6.35. I wanted to check the rate of decrease. Typically this time of the year, the load to truck ratio drops by about 31% from week 2 to 3. This year it was 45% drop from week 2 to 3. So nothing to be alarmed about other than we had a very slow week 1, a very big catch up week 2, and then a more normal week 3. So that's why you're seeing some of the numbers dropping like they are. Next week, we'll see probably a bit more of a return to seasonality. So moving on to the refrigerated load board activity, The load-to-truck ratio dropped by about half for much the same reasons. Load post volumes dropped by 38% week over week. And there are about 20% more trucks looking for loads last week on our load boards. In contrast, though, as Ned mentioned, flatbed load post volumes increased 5% last week. And if you look at our chart there, you can see they did exactly the same in 2018. And despite both years starting with very different economies, both years recorded above average temperatures in the first half of January, boosting flatbed volumes, which is what's happening again. Here in the Northeast, we haven't had any adverse weather for about 6 weeks, which is quite unusual for the start of the new year. So as a result, the flatbed load-to-truck ratio moved to 44.62 loads per truck. So shifting over to the market condition index, in our top 10 markets, load post volumes dropped in all markets this week. That put downward pressure on spot rates. For the top 10 markets, which represent about a quarter of the load post volumes, rates fell by about 11% per mile on average. The number one market again was Memphis. It's the logistics hub of the US. A lot of railroads come in there, a lot of trucks, a lot of cross-border freight ends up in Memphis. Volumes there were the highest of all of our markets, but as was the case in nearly all freight markets, capacity loosened, spot rates dropped in Memphis by 6 cents a mile to $2.50. And on the West Coast, it's been a market we've been looking at for a long time. Capacity continued to loosen in Ontario and Los Angeles. Rates dropped by 25 cents a mile in Ontario and a 16-cent mile drop in Los Angeles. Load post volumes were down 18% and 27% week over week, respectively. And they're now back to pre-pandemic levels in February of 20 and most of 2019. So definitely a slowdown in load post volumes coming off the ports there. Shifting to the refrigerated sector, load post volumes dropped also, downward pressure on spot rates. They fell by 15 cents a mile across the top 10 markets. New Jersey regained the number one position for outbound load post volumes in refrigerated, but volumes did drop by 26%. Week over week, rates dropped 9 cents a mile there also. Very similar effect in Atlanta, which has got about a quarter of the US population within a 500-mile radius. It's a huge distribution market. Rates dropped 16 cents a mile out of there. And last week we talked about a lot of volume coming across the border in McAllen in the Rio Grande Valley, but volumes dropped off there by about 30% week over week, and rates took a reversal to last week, dropping by 11 cents a mile. In flatbed, as we mentioned, warmer weather. A lot of shippers and carriers and brokers are enjoying that opportunity to get some of those materials out to building sites. Memphis was again the number one market for outbound load posts. Capacity was also tight. Rates went up 2 cents a mile. Load volumes in Buffalo, which is a second week in a row we've noticed volumes up there. They're up 24% week over week. Although capacity was plentiful, rates dropped 23 cents a mile. In the southeast, where just over half of all single-family homes are constructed, capacity was tight. In the large Birmingham market, which was number 2 last week, rates increased by 10 cents a mile to $2.92. And to wrap up our weekly update with a quick look at the year-over-year spot rates, as you can see on the chart, we're starting from a pretty high level, but dry van rates did exhibit some seasonality last week. They dropped 4 cents a mile to end the week. Week 3 at $2.18 a mile, even though rates typically decrease throughout January each year. This year, they're starting off 60 cents a mile higher than the same week in 2020. When they were $1.58. In refrigerated, spot rates decreased the most, last week dropping by 8 cents a mile to $2.38. That's excluding the fuel surcharge. For context, that's 46 cents a mile higher than the same week in 2020 when rates were $1.92. Rates are just about 1 cent per mile off where they were in 2018 when capacity was, of course, much tighter. Flatbed rates remained flat last week, staying at around $2.20 a mile, excluding fuel. They've been at this level for about 3 months, which I find fascinating. They've traded in this sort of $2.19, $2.20 range for most of that time. This time last year,
it's a really tight band there.
Yeah. So warmer weather's a big boost. For the flatbed carriers, the La Nina effect is what's influencing the warmer weather. Warmer ocean temps out in the Pacific are impacting this. So the weather forecast is for certainly the next week, typical sort of weather patterns, but they do think the end of January we'll start to see temperatures drop, which could impact flatbed volumes. So that's it for the weekly update, Ned. Over to you.
I do have one question before we roll forward, and that is about you said that La Nina effect. So that's a big seasonal effect, and so if that's likely to cause warmer temperatures in the summer, do you think that there's going to be a corresponding downward pressure on flatbed loads if we have an unusually warm summer and spring?
It's entirely possible, but I think this year there's so much uncertainty in the market because of the pandemic. What we are seeing, though, is that there's some upward pressure on mortgage rates. There is some signs that the building industry is cooling down. So it remains to be seen what happens with inflationary pressures as a result of what's planned with the current administration coming in.
Yeah, no, I've definitely the volume of people offering to refinance my mortgage has started to drop a little bit. So that's my signal for the heat in the housing market.
Yeah.
So before we go into the forecasts, I have to call out something, and Ken would be normally the person to do that. But the forecast charts this week are a little bit different, and it's not because we're showing the long-term forecasts. The short-term model I had been doing some tweaking on because it had been underperforming a little bit, and it was starting, as it started to match the recent historicals a little bit better, it was starting to be a little bit, I'd consider it alarmist. And so we're going to be holding off on showing that this week. We're just going to be showing the RateCast model. I don't think that it's anything to be too alarmed about, but we wanted to make sure that we were showing real effects rather than just me doing some model tweaking to get it to fit historicals a little bit better. I made it a little bit wigglier, if that's a technical term, to try and get it to fit recent historical patterns a little bit better. But yeah, we just don't want to alarm anybody. So that said, we're rolling forward to the Van forecast. So this is just RateCast. So here you see the blue line is the market rates observed by DAT, and then off to the right you see RateCast. And RateCast is continuing to kind of hold what it was expecting, which is downward pressure, maybe leveling off by mid to late February. Although now it's seeing that maybe the leveling off, there's still some underlying weakness and it might be continuing downward. But, RateCast is seeing rates continuing to slide. Not enormously, but still non-trivially. Moving forward to the reefer forecast, you see a kind of similar pattern there where rates are headed down with a little bit of stability and then maybe a continued slide when we get into the later part of February. But again, kind of downward, not a really exciting time for rates, and that's largely due to seasonal patterns. Finally, moving for flatbed, given what Dean said there about the last 6 months of rate trends, RateCast is seeing, again, the blue line is the market rate seen by DAT, the green line is the RateCast forecast, and right in that pattern, it's expecting rates to kind of continue in the pocket with maybe a little bit of downside risk, that 6-month pocket that Dean was talking about earlier of pretty stable flatbed rates, but again, with some downside pressure that's largely seasonal. And that's it for the forecast. Next week, I think, is the long-term forecast. So I know that's everybody's favorite week of the year, or week of the month. There we go, where we go through long-term forecasts. But we'll see. We'll see what we see. Moving forward to the Ask IQ question of the week, and that requires me to go to a completely different document to pull it up. How worried should we be about rates declining was our Ask IQ question of the week. Dean, take her away.
Yeah, I think there is, we've talked about downside risk on a number of shows, before Christmas, because I think most carriers, brokers, and shippers understand that when rates go up rapidly, there's also a downside risk that they can come down just as quickly. We've seen a lot of unprecedented demand activity, so I think this is more of a demand impact than it is capacity, because capacity's been tight, but I think what the market looks like doing is we're past this holiday shipping demand season. Inventory levels seem to have been replenished, stabilized somewhat, and now shippers do have this sort of backup inventory. We typically see a fall off in volumes from Asia this time of the year. Now, so I think there's, if you think about the market that we've seen, and that's why we mentioned the Cass shipment index at the start of the show, where volumes are decreasing. So it looks like the contract freight market is, at best flat to slightly down year over year. So if we think about the surging Asian import volumes coming in through the West and East Coast, that seems to have slowed down, which means that there's less volume going to the spot market. and that's putting some downward pressure on spot rates. So I think we'll be linked at the hip to the recovery of the pandemic, to import volumes, our ability to continue consuming online goods through the e-commerce channels. So I think there's downside risk to rates decreasing. They do this time every year, but I think what is important is they're decreasing from such a high level because of the impact of the pandemic late last year. So that's why we talk about seasonality exhibiting itself. It will appear that the rate of decline is significant in terms of quantity, but it's actually the fact that they do this every time of the year, but they're starting from a much higher level.
Yeah, I mean, it is significant in terms of quantity, but yeah, no, it's not.
Yeah.
It's not unexpected. I have kind of two questions about longer term impacts or midterm impacts in different directions. The first is, I know that we've had unusually high Class A truck orders in the last couple of months, and do you think that that's going to have an impact on the supply side, the supply capacity?
It absolutely could. Typically those trucks that have been ordered late last year for lots of different reasons, to secure build slots, to take advantage of the tax advantages of ordering before the end of the year. That capacity is going to come online mid-year, same as it did in 2019 after the rush in 2018. We ended up with overcapacity late last year. Spot rates declined. It could happen. It could happen, but I think there's something very, very different happening this year, Ned, and it's got to do with the intersection of a return to what kind of looks like normal. So you think about warmer months, economic stimulus coming into the market, a new administration. We've seen the economy showing signs of improvement. Warmer months should encourage people to be outdoors eating more. Hopefully people will start traveling more, will use more jet fuel. Restaurants will start to pick up. So I think the back half of the year, to me, looks like a lot of pent-up demand and possibly much higher levels of activity than what we've seen even last year in the freight market. So I'm looking for a much stronger second half, but I think the next quarter will be much slower than what we anticipated. I think there'll be some slow freight market activity as we get through the worst of the pandemic, and then the economy starts to improve. That's kind of how it feels like at the moment.
Okay. The other question that I have is more kind of short term into that Q1, and that's, I know that there's a big buildup of inventory stocks right before the Lunar New Year, and that's in late February this year. Don't quote me on that. Yep. So we're expecting that to be hitting the warehousing in like late January-ish?
Yeah, I think a lot of those typical volumes you see around the Lunar New Year, and of course it affects other countries other than China, but there's about a billion people, right? So there's about a billion people celebrate Lunar New Year. Right. And in China it's significant because it's a 3-week shutdown of factories, a week either side for people to travel home. And of course, a lot of people travel home and don't come back to work. Because a lot of families in China live in rural communities, so and younger people live in cities, so they travel back home to celebrate the New Year's Eve dinner with their families in their homes. So it's a massive migration of populations in the world. But what it does is it shuts down this whole supply chain for at least 3 weeks, and that's why we're seeing some of this volume on fast forward. On the Trans-Pacific freight line in particular. But I think part of that was shippers were looking to avoid the repeat of last spring where they had a lot of inventory failures when we were going crazy stocking up our pantries in fear that we'd run out of food and staples. So I think shippers have pulled a lot of that volume forward. Again, a bit like spot rates, that volume surge could mean the dip in March that we typically see on imports is even deeper this time around. But these are crazy times, so expect the unexpected would be how I would look at this.
That makes sense. So we've got about 10 minutes left in the show. So if there are any questions, comments, concerns, or burns, happy to hear them. Obviously, you're missing Ken's penetrating insight, and you have instead me, the numbers guy. But Dean's very clever, and I'm sure that he'll be able to answer your questions to the best of his ability. It looks like we got a question from YouTube. No name attached. Any upcoming changes to the freight lane rates? I mean, we don't control that, but I mean, we've been seeing rates heading down. That's the way that things have been trending, and so I I mean, my kind of shoot from the hip answer is right now. Ratecast is showing that rates are headed down, and Ratecast has been doing pretty well. So I would tend to side with that. And then Dean's analysis also tended to suggest a little bit. I mean, not to put words in your mouth. Why don't you actually say what you see for the near future?
Yeah, I think there's some lanes will have higher volumes, but right now, nearly every lane that we've looked at this week has shown, a decrease, and quite a substantial one. So, but I think that's part of the overcorrection we've seen from week 2. There was a lot of spot market activity in week 2 because week 1 was so slow. So when you average it out across the 3 weeks, there's nothing unusual about it. So I think next week should see some sort of more stabilized look in the market. I do fear that there's a lot of capacity in the market. We've talked about tight capacity generally. Certainly larger fleets have experienced tighter capacity finding drivers during the pandemic to get through their training schools, and with the Department of Transport locations where you get your license shut down, you've got to book appointments to go in there. There's been a massive backlog of people trying to find trying to get drivers licensed and seated in trucks. On top of that, you've got the Drug and Alcohol Clearing House, which has caught a lot of drivers. A lot of those haven't returned. I think about 11% of the 46,000 drivers, I think the number is, have only returned to the market after being initially detected. So that's put a lot of strain on large fleets, but smaller fleets that entered the market, there's been a lot more capacity enter. My fear is that we have a repeat of 2018. There's a general theory that orders follow price, and as rates went up in 2018, people went out and bought a lot of trucks. They assumed operating costs on that 2018 numbers, and now we have a similar thing happening again. I think what I've been concerned about is that diesel prices have increased 30 cents per gallon since the start of November. They dropped 70 cents a gallon from January to May last year. So, and then from May to November, spot rates hit record levels. So the margins that carriers were operating on were kind of unprecedented in many ways. If diesel starts to increase, then that could change the balance in terms of what profitability looks like. And I really hope that we don't see a repeat of 2019, where we had ended up with too much capacity because we had too much exuberance in the prior year.
Yeah, the old first derivative differential equation. Or second derivative, e to the x. All right, moving forward. But yeah, no, that's like a very natural pattern of
right.
Like things going up and then that causing kind of their own overworking that tends towards a downside. But no, I think operating costs, I think, are absolutely right. Like there's still a lot of profits to be made right now if you can get loaded. And I think that plowing those profits to make sure that you've got your operating costs in the place where you want them is going to be like a real key.
Yeah, it's like I just looked at the Baker Hughes rig count. So it's the drilling rig count for the drilling industry. So if you think about as the price of oil increases, there's more incentive to invest in drilling more wells. The rig count was up 13 units last week. So, but it's still down 423 from this time last year. So we've had a lot less activity, but with diesel increasing, we're seeing more volume come out of that the freight markets where there's casing, drill pipe, sand, all the other factors that go into it. So it's kind of a good and bad story for flatbed carriers. In particular, there'll be more volume, but diesel will be higher. So I just, we've talked a lot about carriers making sure that they, put money away for a rainy day. This would be a great time to be able to draw on those reserves if volumes start to decrease and operating costs start to increase.
We have a question from a Ken, if that's their real name. What about some head haul, backhaul dynamics in some of these highly unbalanced markets, such as Los Angeles to Denver? Anything changed there?
Volumes are down. I'll just quickly pull up that data, but volumes are down significantly on those lanes. Denver's has been one of those markets like Stockton, Phoenix, where there's a lot of import volumes go in. I'm quickly pulling up the load volume. Yeah, most of the load volume out of Los Angeles went to Ontario, Stockton, Phoenix. Denver was way down the list at the number 5 destination. So I can quickly have a look at some of those rates while I'm padding here that might tell us what's happening with those rates. They're up around $4 a mile last time we looked, but it looked like a lot of carriers were running out to Denver and then back empty from the West Coast. Rates to Denver on those lanes are down this week.
So, yeah, I was looking. We were talking in the work Slack about some markets where you have those kinds of head haul, back haul features. Ken was talking in particular about Los Angeles and Ontario, and there it's kind of interesting where you're seeing like a drop in the rate on both the head haul and the back haul there. He has this beautiful graph that I wish I could show, but I don't think we have that image queued up to share.
Yeah, that was proportionally related, well, directly related to the surge in import volumes we saw in October and November. So a lot of that surge volume hit the spot market, but that's backed right off since. And if you look at the 3-day rate cast, 3-day rates in RateView, what you'll see is that rates on the Los Angeles to Denver market spiked at $3.67 a mile in October, which is around the same time that a lot of that import volume was hitting the Los Angeles port, now down to $3.11. So they've dropped from $3.67 excluding fuel to $3.11. So there's certainly some downward pressure on spot rates on that lane. And I think it's directly related to the decreasing import volumes at the moment.
So I think we've got time for 2 more questions if we can be quick. The first is from Nawab on YouTube. Any tips for the upcoming produce season? This I feel like is more in your pocket than mine.
Yeah, there's a bit of a lull at the moment. Import volumes are down about 12% on the domestic side. If you wanted to say, split it between imports and domestic truckload volumes, import volumes are surging at the moment, largely driven by some of the winter produce coming across the McAllen border, in particular things like avocados and limes heading into Super Bowl. So there's that's sort of driving some of those volumes. We're also starting to get into some decent volumes coming out of Florida with some winter vegetables and strawberry season coming online. So I'd be watching, in terms of the produce season, as we've said on other shows, watch the port markets in particular, like Philadelphia, Wilmington, New Orleans, Houston in particular. Houston has a lot of plantains come across from the South America. The port markets are where we get a lot of our winter produce, as opposed to farms where trucks, directly load. So we see a typical shift this time of the year to port markets as opposed to rural farm markets. So keep an eye on those markets. But definitely, we'll head into some pretty decent volumes as the temperature warms up, heading into, in particular, the Strawberry Festival in Plant City that happens, I think, late January. So we're not far off peak volumes coming out of the Lakeland market. That's one that I'm watching very closely, and it's a great question. We'll do some more research and report back on that one next week.
Yeah, the only thing that I'd add there is I'm not sure. Are we allowed to say Super Bowl? Do we have to do the big game thing that the NFL demands? That I don't know.
I didn't realize there was something we had to say.
There's a weird advertising rule where you have to pay the NFL if you want to use the name in your ads. So
okay.
That's why there's a lot of stuff for the big game.
Game.
Yeah. Anyway, last question from Oasis Trucking. Do you think the downtrend will go up until the end of Q1? And I think that I'm going to do some interpretation on that, and that is that the rate of decrease will tend to go down, will tend to increase until the end of Q1. And then they've also asked for insights into Newark, New Jersey. So take it away.
We'll have to take Newark, New Jersey on notice. I'll do some research on that one, and we will report back next week. But volumes were down in Elizabeth, New Jersey this week. But we'll do some research on the port volumes to see how much that's impacting that market.
I would say that for the downward trend, there is a lot of downside risk. Ratecast is expecting things to level out, and then maybe for that negative, that first derivative to go negative again. Moving for it's mirrored on my screen, of course. So for it to go forward and then the first derivative to go a little bit negative when we're heading into late February. And longer term, I need to look at the long-term forecasts. I didn't have those prepped, but the short-term forecasts are only going out towards the end of Q1, and they're expecting sustained downward pressure on rates in Ratecast. And I feel like Ratecast has a pretty good handle on kind of normal seasonal patterns. I think there's some additional downside risk that Dean was talking about. But there is a potential for some upside. But I'd say I would be more prepared for further slides in rates than I would be expecting rates to go back up. Dean, do you have anything to add to that?
I could just quickly answer that question on Elizabeth, New Jersey, if I could just quickly get that one covered.
Until you pull up Elizabeth in Newark.
Import volumes were up 23% year over year. They, for perspective, Elizabeth, New Jersey receives about 16% of all TEU volume. So volumes were certainly up there, but I think a lot of that volume has moved prior to last week's data that ended Sunday night. So load post volumes are down 10%. There's a lot more capacity in the market last week, so that put downward pressure on spot rates. Out of Elizabeth, rates were down 4% on average. They're down about 1.3%. So there's a downward trend in spot rates out of Elizabeth, New Jersey, which is sort of correlating to the decreasing port volumes on the import side.
So do you have anything to say about the downward trend in Q1 before we wrap the show?
Yeah, I think I would agree. We've talked about a slow Q1 on prior shows. I think there's the first quarter is going to be much slower than a lot of people would have hoped. I think largely because the industrial production manufacturing side of the economy is still to ramp up. So we're not seeing a lot of that tonnage that would normally come from that side of the economy. So I think until that really kicks in, we won't see freight volumes start to return to normal. But certainly by the end of Q1, end of March kind of correlates with the low point in shipping imports, sort of globally into the US. So I think that's sort of how that'll play out. We'll see, slower volumes through March, and then things will pick up consistent with the warmer weather.
I think that's about it for our show today. I want to thank everybody for joining, even in the absence of Ken. I know that he is certainly sorely missed on my end about being able to organize and keep us all on the rails. Next week will be a very interesting one. I think I'm allowed to mention that there might be a guest. I think I've mentioned it. It's done. And then there's the standard end of show shout outs. I want to thank everybody for joining us this week. Freight Vine is a fine podcast done by Chris Kaplis, so you should do that. Also, Dean, do you want to shout out your market update and your media?
Yeah, sure. Stuff? Yeah, we do the weekly market update. We put out a long-form publication at DAT.com market update. So a lot of the detail that we covered in the weekly update are detailed in that report for you each Wednesday evening when it gets posted.
I want to remind everybody that if you like this content, please do so, subscribe, comment, do all that good stuff so that we can continue to justify our appearing on this show. You can find that Dean's Market Update at dat.com/market update. You can email questions if you have them outside of normal show hours to askiq@dat.com. I'm not saying that we'll give good answers, but we will give answers. Also, we have our top 50 lanes report that you can get by emailing that address. That's a fine resource for people who want just like a quick bite-sized summary of what's going on. And finally, next Tuesday at 10 a.m. Eastern, we'll be doing our next show. So I look forward to seeing everybody there, and hopefully Ken will be back, and that would be grand.
Okay.
All right. Bye.